Welcome to TalkTickers. Today we're doing a deep dive into SER's latest earnings call.
Yeah, that's right.
Our mission, as always, is to, cut through the noise, distill the key info, and really give you the insights you need on the company's current state and where it might be headed.
Okay, let's kick off with the numbers, the snapshot. So first quarter 2025 adjusted EPS, that came in at $1.44.
Okay.
Which is up from $1.34 in the same quarter last year. So decent growth there.
A nice little bump.
Yeah. And importantly, they reaffirmed their guidance. So for the full year 2025, they're sticking with that $4.30 to $4.70 adjusted EPS range. And looking at to 2026, it's $4.80 to $5.30.
So no surprises on the guidance front then. Holding steady.
Holding steady. And they also kept that long-term target, the 7 to 9% compound annual growth rate for EPS running from 2025 through 2029.
Right.
They even mentioned possibly hitting the high end of that or maybe even a bit above it.
Okay, so confidence seems high. Let's get into the how. What are the big strategic moves, the value creation initiatives they talked about?
Well, a major one is investment. They're planning about $13 billion in energy infrastructure spending just in 2025.
$13 billion. Wow.
Yeah, and over $10 billion of that is specifically for their U.S. utility businesses.
Okay, focused on the regulated side. Makes sense.
Exactly. And alongside that spending, they're actively working on, let's say, improving the regulatory compacts in Texas and California. That's always crucial.
Always. The state regulations can have such a huge impact. Anything specific on what they're doing in Texas or California on that front?
Well, in Texas, they're, keeping a close watch on the current legislative session. They're hoping for outcomes that might benefit their transmission and distribution investments. And Oncor, their Texas utility, is also getting ready to file its big base rate review sometime this second quarter.
So a key filing coming up there.
Definitely. And the growth signals in Texas are, frankly, pretty remarkable. Premise growth is up 3% year over year. Yeah. New connections for transmission points of interconnection up 66% year to date.
66%.
Yeah. Total active requests up 35%. And that queue for large customers, think data centers, big industrial users, is growing at a record pace, up 30% just quarter over quarter.
That LCNI queue growth is staggering. Data centers really driving that, you think?
It seems to be a major factor, yes. And you see it in specific areas too, like West Texas peak load up 3%, the Culver transmission loop demand up 41%. It's a pretty broad-based growth.
Well, given all that growth, they mentioned transmission plans, right? The ERCOT projections and specific voltage lines.
They did. ERCOT is projecting peak load hitting 150 gigawatts by 2030. Which is a massive increase. And they're proposing a big regional transmission plan. We're talking 345 kilovolt lines and significantly 765 kV lines.
765, that's pretty high voltage.
It is. It offers much more capacity, more flexibility for siting generation. Operationally, they seem to prefer it for these big build-outs. The total investment estimate for this whole plan is somewhere in the $32 to $35 billion range.
Huge numbers. And Oncor's role?
Well, Oncor owns a lot of the existing endpoints, so they're really well positioned to build a significant chunk of this new infrastructure. They're currently assessing the full impact, but they expect to build, potentially over half of it.
Okay, so Texas is clearly a major growth engine. Let's shift over to California. Always a different beast, regulatory-wise. What's happening there?
Yeah, definitely complex. Both SDG&E and SoCalGas have filed new cost of capital applications. This is for the period 2026 to 2028.
So asking for updated returns.
Essentially, yes. They want updated rates of return that reflect, current market conditions, interest rates, risk profiles. SDG&E asks for an 11.25% ROE with a 54% equity layer.
Okay.
So CalGas is asking for 11% ROE with a 52% equity layer. The CPUC, the regulator there, should decide by year end with rates effective at the start of 2026.
Got it. And that's separate from the FERC filing for SDG&E transmission.
Correct. There's a separate FERC TO6 filing. The current rate there is 10.1%, though there's some ongoing appeal stuff. New interim rates are actually set to kick in June 1st, but they're subject to refund. Settlement talks are ongoing there too.
Lots of moving parts on the regulatory front. Anything else significant in California? Battery storage, affordability?
Yep. The CPUC approved an expansion of their West Side Canal battery storage facility. They're adding 100 megawatts to the existing 131. That should be up and running this summer.
Good timing for summer peaks.
Exactly. And on affordability, customers did get those one-time California climate credits you mentioned earlier. $136 for SDG&E, $87 for SoCalGas in Q1. SDG&E gets another one in October.
Some near-term relief, at least.
Right. And then there's the ongoing review, track 3 of the 2024 rate case, looking at pipeline safety costs and wildfire mitigation costs. But a decision there isn't expected until the first half of 2026.
Okay. Now, outside the core utilities, you mentioned SCR infrastructure and potential asset sales. Can you elaborate on that strategy?
Sure. So they're planning to sell a minority interest in SCR Infrastructure Partners, or SIP. They mentioned really strong market interest in these kinds of assets right now.
Trying to capture that high valuation.
That seems to be the idea. Highlight the value they've built. There's a process involving rights of first offer for their partners, KR and ADIA, but SCR is prepared to go to third parties if needed. We should get an update on their next call in August.
Okay. And the other sale, ECOS.
Right. They also plan to sell ECOS, which is their regulated gas distribution business up in northern Mexico, and potentially other non-core assets too.
And the rationale behind these sales?
It's really about recycling capital back into their main growth areas, simplifying the overall business, maybe reducing the need to issue new stock down the line, and potentially boosting EPS and credit metrics.
Makes sense. Streamlining. How are the big infrastructure construction projects going? LNG, wind?
Generally moving forward. Cameron LNG Phase 1 had a good quarter, 55 cargoes loaded, 98% reliability. Cimarron Wind is targeting first power late this year, commercial operation first half 26. EKA LNG Phase 1 is about 92% complete, aiming for commercial operations in spring 2026.
Okay.
Port Arthur LNG Phase 1 is also progressing, though they did mention a safety incident there recently. They've also started using foreign trade zones to help manage potential tariff impacts on materials.
Smart move on the tariffs. What about Phase 2 of Port Arthur LNG?
They're still targeting a final investment decision, or FID, by the end of this year. They say commercial interest is strong, but they also acknowledge that, macroeconomic uncertainty could affect the timing. They really emphasize managing cost risks before committing.
Prudent, given the scale of these projects. Okay, let's circle back to the financials for Q1. You gave us the adjusted EPS, but what were the main drivers behind that year-over-year increase?
Sure. So the adjusted earnings were $942 million, or 1.44 cents per share, up from $854 million, or 1.34. The biggest positive drivers were higher CPC-approved operating margins at SCR California, and also some higher income tax benefits there. That was partly offset by lower equity earnings from SR Texas. That was mainly due to higher interest expense and operating costs down there, even though revenues were up. SR infrastructure results were largely flat, and the parent level saw a decrease, mostly from higher net interest expense.
Got it. A bit of a mixed bag across the segments, but overall positive on the adjusted line.
Exactly. And the GAAP earnings were also up, $96 million versus $81 million last year.
So looking ahead, they reaffirmed guidance, expressed confidence, particularly about hitting the high end of that long-term growth target. What's giving them that confidence?
A lot of it seems tied to Texas, specifically Oncor. The potential scale of that transmission buildout, especially if those 765 kV lines get formally included in the capital plan.
Right, that huge potential investment.
Yeah. Plus, their ongoing efforts to improve the regulatory situation in both Texas and California are key. They're also focused on cost management, including dealing with any tariff exposure, though they said the direct impact on utility capex is limited.
And long-term, they're aiming for mostly regulated earnings.
That's the goal, 90% or more regulated earnings and cash flow mix over the long run. And again, that massive growth in interconnection requests in Texas, especially from data centers, just seems to underpin their whole growth story.
Okay, so if you had to boil it down for investors, what are the main takeaways from this call?
I'd say it highlights a clear focus on regulated utility growth, funded partly by strategic sales of non-core assets. Cost efficiency is also a big theme.
Right.
The Texas transmission opportunity is potentially enormous for Oncor and represents a major long-term growth driver. But the regulatory outcomes in both Texas and California remain really critical to watch.
Absolutely.
And progress on the LNG projects and the Sempra infrastructure sale are key for their capital plans and, unlocking value. And don't forget that surge in Texas connection requests. It's a powerful signal of future demand.
Okay, great summary. Now let's shift gears to our not financial advice segment. Time for some outrageous but plausible trade ideas based on all this. What are you thinking?
All right, first idea. Given SER's confidence in that long-term growth, hitting the high end or better, plus the potential upside from that massive Texas build-out, which could even exceed forecasts. How about this? A long position in SER.
Okay, straightforward long.
Yeah.
What's the hedge of the twist?
Well, to maybe isolate the SER specific story, you can hedge it with a short position in a broader regional utility ETF, one that maybe doesn't have as much exposure to a super high growth state like Texas.
Ah, okay. So betting on SER outperforming its peers.
Exactly. The outrageous part is really betting heavily on perfect execution of these huge projects and getting favorable regulatory outcomes all lined up. A lot has to go right.
It does. Okay, interesting idea. Got another one for us.
Second thought, playing off that specific Texas data center boom, we know data centers use a ton of power. So consider pairs trade. Long SER because its subsidiary Oncor directly benefits from selling all that extra electricity.
Right, on the other side.
Short a data center REIT. The thinking is, while SER profits from higher demand, the data centers themselves might face margin pressure from potentially rising energy costs, especially if they can't pass it all through to their tenants quickly.
So betting on a divergence where the utility gains are potentially the data center's higher costs.
Sort of. It's a bet on that dynamic. The outrageous part here is making such a direct link between utility infrastructure spending and potential profitability headwinds for data center REITs based purely on energy costs. It's a specific, maybe slightly tenuous correlation to trade on.
Definitely requires some conviction in that specific relationship. Very interesting ideas, though.
Purely informational and entertainment, of course.
Of course. Always. Well, that wraps up our deep dive into SRE's latest earnings call. We've covered the financials, the strategy, the state-level updates, infrastructure projects. Quite a bit.
Yeah, a lot going on there.
Hopefully this breakdown has given you a clearer picture of the key takeaways and what to watch going forward.
And just to reiterate one last time, those trade ideas, for discussion, for thought stimulation only, not financial advice.
Absolutely. Do your own research, make your own decisions. We'd love to hear what stood out to you from the call or any questions you still have. Feel free to engage with us. Thanks for tuning in to TalkTickers.
Thanks, everyone. Join us next time for another deep dive.